Hello friends, welcome to yet another video in our series Finance and Investing Tidbits. The theme of this video is a lot of cash on the company's balance sheet good for investors, that is shareholders or potential shareholders? Holding sufficient cash, that is liquid resources, is necessary both for smooth operations as well as for strategic reasons. So having sufficient money is important, otherwise it can lead to a lot of disruptions in operations. As well as there are some strategic reasons such as acquisition opportunities, expansion opportunities for which having sufficient cash is necessary. When we say sufficient cash, we are not talking about, of course, currency notes or money lying in a bank account. We are talking about money parked in short-term investment instruments, which can be very quickly converted into cash or money and then can be used for these strategic reasons as well as for operational reasons. Till the money is actually put to use, as we have just mentioned, this surplus cash is not actually being used in business, but is being parked in short-term instruments. Now they can be money market funds, bank deposits, short maturity bonds, certificates of deposits, yielding a very low return. Shareholders generally are not too happy with such large surpluses, as they would rather want this money to be deployed in business opportunities rather than in such passive investments which they themselves could do. And naturally, the pressure mounts on managements to give back this surplus cash. The important thing is that the plans of the company for expansion, acquisition are held under wraps. The company would never make them public since they have to be unfolded only at the right time. And even to the shareholders who are actually external entities to a company, the company does not reveal any data other than what it is mandatorily required to disclose. And therefore, a lot of this information is in a non-public domain, in a confidential domain. Hence, investors have no choice but to wait patiently and see cash resources accumulate on a company's balance sheet with the hope that the management would act on them at the right time, either in its expansion or acquisition opportunities, or someday it would return that cash back to the investors. Excess cash resources also reflect in higher equity since the profits are distributed less to shareholders to that extent than they could have been distributed in the past. Equity includes undistributed profits, which are called as retained earnings or reserves and surplus. Large equity brings down the return on equity, which is also not good for shareholders, and neither it is good for the company's management image. Thus, the management has to exercise a fine balance between keeping cash available and running out of it to take advantage of opportunities that come its way. Shareholders, investors need to examine the track record of the company in terms of timely expansion and acquisition decisions before forming a judgment or before becoming impatient about cash on the balance sheet. Once the company is clear it does not need that cash, it will begin to give it back to shareholders by way of dividend and often liberal buybacks. That is great for shareholders since it means more cash in the hands of the shareholders, and such actions of liberal dividend and buyback are also value accretive since it shows that the company has sufficient cash to be able to generate free cash flow, and yet it is not unnecessarily holding cash on its books and has given it back to the shareholders. So that also generates a lot of confidence that the company does not have to keep on investing in the future to generate stable and growing cash flows. Thank you for watching. Do share it with your friends if you liked it. Thank you. Bye.